What's up, everyone? It's Eric with Option Edge, and today I want to talk about one statistic that you're probably not using in your options trading to make you a better trader. Okay, so what exactly is that statistic? It is the IV rank. Okay, so I've prepared a little slideshow. Let's go to the slideshow. So using IVR or IV rank to profit more with options trading is the title of this. So before we get into it, let's first review what exactly is IV or implied volatility. So implied volatility refers to how much a stock may move within a year time frame. So a larger implied volatility percentage, the more likely the stock is going to move. The smaller that volatility percentage, the less likely, the less fluctuations in price you're going to see. So think of high volatility stock like Tesla. That's going to have a lot of price movements versus think of like a stock like maybe like a dividend stock. I don't know, Sprint is probably not as volatile as a high growth company like Tesla. Okay, so and just to give you guys an example, let's say we have a stock that's $100 and it has an implied volatility of 50%. So what does that mean? That means in the course of a year, with a 68% probability or one standard deviation, we can expect that the stock will go up or down $50. So in a year, it could be at $50 or it can be at $100. Okay, so that's sort of what it is. So if it's a 20% volatility, that stock could be either at $80 or $120. If it's a 30% volatility, that stock could be either at 70 or 130, and we can have a 68% confidence that that will happen within the year. Okay, so that's implied volatility. So what exactly is implied volatility rank? Okay, so this is how we're going to do it. Let's start with the picture here. So if we have, in order to calculate implied volatility rank, we're going to look at over the course of a year. We're going to look at the high implied volatility rating for that year, and then the low volatility rating for that year, and then compare that with what we're currently at. Okay, so basically, we're looking at the high and we're looking at the low, and we're saying where are we in regards to the high and low of implied volatility for that year. Okay. So this is basically just what I said in a given, take the highest and the low and compare where the current IV is, then give it a ranking. Okay. So, and here's the calculation. Most softwares, the trading software can tell you this. Okay. So it gives us a way to compare, an individual stock's IV movements. So for example, let's go back over here. So if I was to say, hey, IBM, or we'll stick with Tesla. Hey, Tesla has a 15% IV right now. And it's like, okay, is that high or is that a low? I don't know. So I need some sort of context. And that's basically what, by using the IV rank, we have a context of whether that is considered a high IV compared to where it's been over that course of the year. So let's pause this and go into just look at some Robinhood options chains. So I'm looking at Tesla's, what are we at? We're at the 790 call in Tesla, November 19th expiration. So you can look on Robinhood, see implied volatility here. But the problem is I don't know if that is high, if that is a high volatility for this particular stock, because I have no context to compare that to. Okay, so there is free options to look at IV rank. So Tastywork does a good job of giving you and this is, you just sign up and get this info. And I can look right here and it's got a 25. Okay. So that's like the percentage. Whereas, so 25% isn't that high. Okay. For Tesla, 70% would be high, right? Anything over 50, you can think of as being having high implied volatility. And let's look at, I don't know, let's compare to another stock real quick. Hold on. All right, now we're looking at Apple, November 19th expiry. I can already tell you, I know that Apple is a much more established company than Tesla, and that the price fluctuations for Apple are smaller. So I already know that the implied volatility will be lower Okay, so if you remember, Tesla was like 45-ish. This is 25-ish. So my question is, though, is this high for Apple? I don't know, because I don't know where Apple's been, in where its implied volatilities have been over the course of the last year. So let's just do this. Go over here, Apple. So real quick, what's great about Tastyworks, I can get a nice little visual of how high that IVR is. And what's cool is they also have this little circle. It fills up. The more IV, or the higher the IVR, the more the circle's filled up. So you can see this one. I just sold a put in this company. I don't even know what it is, but and I'll get into why selling during high implied volatility environments is beneficial as an options trader. Okay, actually, let's get into that right now. So that I just explained IVR. I hope that makes sense. So let's talk about, let's skip to IVR advantages when you're selling. So when you're selling an option that has a high implied volatility, you're going to increase the credit you receive, okay? So if you're selling, let's say, a 20 delta put, okay, in a high implied volatility environment, you're going to receive a higher credit, okay? So you can think of a 20 delta put, your probability of profit is going to be around 80% because you have because a 20 delta means that you have a 20% chance of being in the money if you're buying the option. But here we're selling it, so you would do 1 minus the delta of 20, and that gives you an 80% chance roughly of staying out of the money. Okay, so what's great is now with that, if we take a 20% or a 20 delta option where the IV rank is low, you're not going to receive quite as much of a credit. Okay, so another thing is we can increase the strike widths while keeping the same deltas. Okay, so that by doing that, that's going to increase our probability of profit. So that's sort of what this is saying: increase the break-even points. And we can receive the same credit while taking less risk. And the next thing to go over is IV and premiums. Around 80% of the time are overstated compared to historical IV. Okay, historical volatility. So that might be a little confusing, this slide. So let me show you a Tasty Trade has great. They really have great stuff, great info and studies and stuff like that. So they did a study, Tasty Trade, selling strangles. Okay, so they sold. They tell you what strikes they sell the strangles, and this is in the S&P 500. Okay, so they're looking at when IV is low at 16% versus when IV is a little higher at 26%. Okay, so right here you can see that if we go back to the slide, I was talking about receive the same credit while taking less risk. So let's see how that plays out. So they're going to receive the same credit while increasing the distance of the strikes. Okay, so if you can visualize that, let me pause this and we'll get this. I'll try and show you how that's going to look. All right, so I wanted to show you guys how this works. So right now, we're on the S&P 500. I'm showing you what it's like to sell a strangle. So we make money when the price of the underlying stays within our strikes. Okay. So as you can see, this is our bars here right at our break-even points, right? So if we have a higher implied volatility, we can actually further those strikes out and reduce our risk and increase our probability of profit while receiving the same amount of credit in a lower implied volatility. So we're going to take the put side of the strangle and we're going to increase it 10 strikes to the downside, okay? And then we're going to take the call side, okay, and increase it 10 strikes to the upside. So what's going to happen is you're going to see these green arrows are going to widen. So that widening is literally your odds of breaking even are now, you can visually see that you now have a larger chance because the stock is going to fall, has a larger distance to fall while you are still profitable. Okay, so let's continue with this. And so that's showing you the strength, the strikes at the same price or strikes at different price, and how we can receive the same credit while reducing risk. So if we keep the strikes the same, look at the difference in credit. So by taking we're taking basically the same risk, but look at how much more we're compensated for that risk. Okay, so this is how you make money in the options market, by selling options. Okay, so let's go back. So those are the advantages of selling. So basically all the advantages I just showed you of selling are going to be disadvantages when buying in high premium, high IVR environments. One, you have to pay a higher premium. Okay, so let's pause this and look at another Robinhood example. Okay, let's say I think in the next month and a half, I think Apple is going to go over $145. I want to buy a call. Okay, so in order for me to make money at expiration, you can obviously make money before expiration if the stock moves a little bit to the upside, but we're going to keep this simple. If we want to be in the money, if we want to make money at expiration, not only does the price of the stock have to reach the strike, but it has to reach the strike plus the premium paid for the right, but not the obligation to buy or sell or 100 shares of Apple. Okay, so you take the strike, add the premium, so 145 plus 390 gives us 148.90. Okay, so that's our break even if we're buying a call. Now picture, we showed you before that the implied volatility is 25%, which is around 23 of an IVR rank, which I showed you IV rank. So let's say, what if Apple was at a 50% or a 60% IVR? Okay, that what's going to happen is the pricing, the premium paid is going to be more expensive. So let's say instead of paying $3.90, we now have to pay, let's say $5. Okay, so what is our break-even point going to be? Well, it's going to be 5 plus the strike. So that means it's going to be 150. So in order to make money at expiration, the stock now has to travel to 150. So you can see, if you're an option seller, you now have a better probability of, if we pick the same strike, you now have maybe not. You now have you've increased your break-even point, and you're collecting a larger credit, okay, for the same risk you're taking. So that is what's so powerful about selling options in these high IVR environments. So conversely, so what am I saying? Have to pay a higher premium, increase break-even, decrease probability of profit. Premium paid for option is usually overstated compared to historical IV. So that's a little confusing, and I can show you what that means. So another Tasty Trade study, they showed that the expected move is actually overstated than the actual price. Where the actual price moves. So that's implied volatility is overstated compared to historical volatility. So that means is, as an option buyer, you are paying for premium more often than not. Okay, so that's why in many ways you do have an edge as an option seller. And so the flip side of that, conversely, if you want to buy options and be a buyer of options, then what would be a good environment to do that in? Well, you'd want to do that when the implied volatility for that particular stock is low, when it's a low IVR. I made a Palantir video about lately. I was selling puts in Palantir, but the IVR was 0. And I said, hey, maybe I should buy a call spread. And that's what I did. And I can link to that video up top. So we talked about advantages and disadvantages, and then let's sum it up. Main takeaways. So buying options when being a buyer of options when IV rank is low that's the best time to buy options, when IV rank is low. You want to be a seller of options when IV rank is high, and we talked a lot about that. The majority of the time, IV is overstated compared to historical volatility. So like we said before, the implied or expected volatility of a underlying is usually much greater, not much, but greater than what the actual or the historical volatility ends up being. So this means that you actually have an edge as an option seller, and you have an edge, a larger edge, when implied volatility rank is high. Okay. Hope that makes sense. If you have questions, please comment. As always, this is not meant as any type of financial advice. If you're liking this stuff, please subscribe, like my stuff, comment, talk to me. I try and make videos based on what people are asking me. So, alrighty. Hope you guys have a good day and have a good weekend. Peace out.